Hello, class. It's Brother Spalding again. I just wanted to take some time and go over with you the information in Guided Practice 2, applying financial functions of present value and net present value. This is interesting. These are interesting functions that are used rather widely in by financial institutions and individuals dealing with finance. And here we wanted to demonstrate them because this is a good opportunity for us to see how they might work. First of all, if we take a look at the instructions, we'll notice here that it gives a little bit of background about them, but not a lot. Basically, the present value function then is used to find the present value of a constant return or a constant stream of income over a period of time. For example, we might have money coming in at $100 every month, every year, year after year for 5 years, and that $500 then distributed over 5 years, we know that it's not worth the full $500 because we don't have it in our hands right now. And in fact, that first $100 is going to be worth quite a bit more than the last $100. Now let's take a look at this example here, and I think it'll make a lot more sense. If you look at this table in the instructions, it shows you the two scenarios. Our first scenario is a situation where we have constant returns, and now in this case we have a return of $300 every year, year after year for 8 years. In the second scenario, we have variable returns where we start off with 300 in the first couple of years, and then the amounts go down over time. Now, what we want to do then is look at these, and we're basically assuming then that our investment, and let me bring up our Excel file here, our investment that we paid for our machinery is going to be $1,500. Okay, now as we look at this particular table here, we see that in one situation, the amounts are equal all the way down, which simply means that if we purchase this thing and then over the course of the first year, we had a return, a net return of $300. And then over the course of the second year, we had a net return again of $300 in actual dollars. However, we need to understand that if we're standing here today and we're looking forward to the future, and we know that this last $300 we're not going to get for 8 years, then in terms of real value today, that the $300 in 8 years is going to be worth quite a bit less to us than the $300 will be in the first year. And so that's simply because of the time value of money. And we know that because of interest rates, we could put a certain amount of money in the bank today, and by the time the 8 years come along, it would have grown to a considerably larger amount. And so what we're doing is just the reverse of that. We're simply saying, okay, if we don't receive this money until the end of this period, then basically how much is it worth to us today? And that's basically what we're looking at. Now, the information in the lesson gives some detail about this, and I want to go ahead and get started. Now, if we take a look at the lesson material, you'll see that it simply tells us, okay, now in cell C29, and that's this one right here, we want to go ahead and create a function. Okay, we're going to create a present value function. So we start off by putting an equal sign in there, and then we're going to type in our PV. Okay, then we're going to put in an open parentheses. Now, when we put in the open parentheses, note this little box that comes up under here, and the very first parameter in that box is that rate, R-A-T-E. The second one is NPR, NPER, and that's a number of payment periods. And the last one is the amount of the payment. And so how much is the rate? It tells us in the lesson. that rate is going to be 10%. So we just simply type in our 10% and then put a comma. And then we know that the number of periods is going to be 8. So we type in 8 and put in a comma. And now the amount, and we're going to be looking at this first scenario, the constant amount here of $300. And then we put in our closed parentheses. So the value that we have in here, if you look up at the top at the formula bar, you'll notice it says PV, or parentheses, 0.10, that's the interest rate, comma, and then 8, that's the number of periods, and comma, and then $300, and that's the amount that we're basically, that's the amount that we're basically receiving every year for the 8-year period. Now what we want to do is find out how much that stream of income, the $300 each year over an 8-year period. And then we click on our check mark up here. We click on that, and that basically tells us what that amount is. Okay, it's going to be a negative. Now there's one thing that I need to do up here. I need to modify this. It explains in the lesson, and I forgot to do it. We put in a asterisk, and then we're going to, that's going to multiply it by a -1. And so we add the asterisk here, which means we're going to be multiplying that by a -1. And so now we click on the checkbox again, and that changes that to a positive value. Now we want to do that because what we're going to do is compare this value to the equipment purchase cost up here. And so down here in cell C30, we're going to click on equal sign, and we're going to click on this new value that we put in C29, and then we're going to click the minus, and we're going to click on the value of the equipment purchase down C28. Okay, and then click on our check mark up here, and that tells us we have $100.48 is the amount that our purchase has gleaned for us in terms of revenue over and above what it cost us. And so over that period of time, based on this constant value over time, we can see that we do have a positive $100.48. So since that value is positive $100.48, we can see then that the present value of our returns is going to be greater than the cost, which means that it would be appropriate and profitable for us to go ahead and invest in that machine. So this is a very, very useful tool to help us to be able to determine whether or not it would be worthwhile to us to go ahead and invest in a piece of machinery. Now it's really important to understand though that we need to be careful and be as accurate as we possibly can in calculating these values in order for us to make sure that we're not fooling ourselves and not basically calculating some numbers here that are including some numbers here that are really not realistic. And so we need to make sure that we're being as realistic as possible. Now the second part of this is going to be looking at this last one down here. And this is where we're going to be using the net present value feature as opposed to the present value feature. Now you'll notice down here that we already have the $1,500 equipment purchase put in place. Okay, now we can go ahead and we can calculate the returns on the variable part up here, but we need to do each one of them individually. Now we could go ahead and take the same formula, the present value formula that we used up here in this particular thing. We could use that and do that individually on each one of them. And if we did that individually, so we'd have our, here are $300, and they would have our 10% interest. And then in here, instead of 8, we would put 1. And if we went ahead and calculated each one of them that way, we would get the values that we were looking at on the lesson. And let me point those out to you real quickly again. And here would be those values that are shown in this version of the table in the instructions. And so if we went ahead and used that present value formula up here and did each one of these individually, then these would be the values that we would get. And then we would have to add those all up. Okay, now it's not all that difficult, but the net present value formula is a much faster way to do it. And let me show you how that works. Okay, so we're going to go back down here. Okay, and in this cell, we're going to click on that. I'm going to click on the equal sign, and then we're going to put in NPV. Now here, notice that if you can look at this, see this box, it's down pretty low here. If you can look at this box, it says NPV and then rate. So the very first parameter we're going to put in there is going to be our 0.10. That's our rate. And then value all the way along. And so what that's talking about is that we have in our table up here all of the values that we need. So I'm going to put in, click on the, like that, so I'm not sure what I've drawn. Okay, and I need to put in the comma. That's what I need to do. And I click on that value, and I can click on another comma, and I can just click on that value, and then another comma, that value, and then another comma, and that value, and then another comma, and that value, and another comma, and then that value, and then the last one here. I've got too many in there. I've got one too many. Okay, I do have it correct here, so I've got my comma in up here, you'll notice. And so now what I need to do is to click on the next value, which is in D20, and then put another comma in, and then click on D21, and that's the last of them. So let me count them. I've got D14, 15, so D14 would be 1 year, 2 years, 3 years, 4 years, 5 years, 6, 7, and 8 years. So I have the information for all 8 years. So simply go ahead and click the closing parentheses, and I've got all of them in there. Now let's hope I got it right. And we'll go ahead and we'll click on our little check mark, and we have 1,263. And I'm quite sure that's correct, but let me double check. Sorry about that, I got it wrong. So anyway, I'm quite sure that that's correct. So we'll leave it at that for the moment. But anyway, that's the way you do that. So it's just a matter then of creating this formula up here, down in this box here at C24 or 34, C34. Now, what we would want to do is the same thing that we did up here, and then an equal sign in C35, and we want to take our, we returns, which is in C34, and subtract from it the value of the initial purchase of the equipment in C33, and then click on our little check mark, and lo and behold, look what happens. In this particular case, we notice that the value is negative, and that's simply telling us that the returns, the net present value of the returns, are not high enough to justify purchasing that machine at $1,500. And so if this is accurate, we knew that this was accurate, then we would simply say no in terms of that decision. So we're looking forward to trying to determine whether it's going to be profitable or not to buy the machine, and basically using the scenario number 2, the answer is going to be no. Using scenario number 1, the answer is going to be yes. Now, what this simply should demonstrate to us is how important it is for us to make sure that the numbers that we're looking at here are going to be accurate. So we want to make sure that those numbers are accurate. That's really all that I wanted to say about this, and I hope that you can all understand and follow it, and wish you the very best. Thank you very much.